1775. The American Revolutionary War began as the American colonies sought to detach from England and its oppressive monarchy. Though many reasons are cited for the revolution, one in particular sticks out as a prime cause: that King George III of England outlawed the interest-free, independent currency the colonies were producing themselves, in turn forcing them to borrow money from the Central Bank of England, immediately creating economic hardship and despair. In the words of Peter Cooper, former vice president of the New York Board of Currency, after Franklin had explained to the British government as the real cause of prosperity, they immediately passed laws forbidding the payment of taxes in that money. This produced such great inconvenience and misery to the people that it was the principal cause of the Revolution. In 1783, America won its independence from England. However, its battle against the central bank concept and the corrupt, power-hungry mentality associated with it had just begun. So what is a central bank? A central bank is an institution that issues and regulates the currency of an entire nation. Based on historical precedent, the typical powers inherent in central banking practice include the control of interest rates and the expansion and contraction of the money supply itself. Now, the central bank does not simply issue money to the government, it loans it to them with interest. Then, through the mechanisms of increasing and decreasing the supply of money, the central bank essentially regulates the value of the currency issued. It is critical to understand that the entire structure of this system could only produce one thing in the long run: debt. It doesn't take a lot of ingenuity to figure this scam out. For every single dollar produced by both the central bank and its regulated commercial banks is loaned at interest. That means every dollar produced is actually the dollar plus a certain percentage of debt based on that dollar. And since the banking system has the monopoly of the production of the currency, and they loan each dollar out with an immediate debt attached to it, where does the money to pay for the debt come from? It can only come from the banks again, which means the banking system has to perpetually increase its money supply to temporarily cover the outstanding debt created, which, in turn, since that new money is loaned out at interest as well, creates even more debt. The end result of this system is essentially slavery, for it is technically impossible for the government and thus the public to ever come out of the self-generating debt. By the early 20th century,